You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
Hi all, great, thanks.
Where are you calling in from?
This week I'm calling in from sunny Italy, all the way down south in Sicily.
Oh my
We're
gosh.
outside to Etna, the volcano, still spewing up some ash after the eruption a few days ago.
Well, be careful out there. Are people wearing masks or are they just outside and used to it?
I think somewhere else they say it's an eruption of a volcano. Down here I think they're just calling it Tuesday.
Okay. Well, stay safe out there. I hope you have a nice time. Let's get started with the news. We've got a packed agenda today. Maybe we start with some rates. What's going on there?
Let's start with the rates and jump straight into, I think, what has at least captured a lot of people's headlines, these skyrocketing rates on the Pacific. And this is where it becomes kind of interesting, because if you look at the most headline-grabbing numbers, you would look at a place like the Shanghai Container Freight Index, for example, where this has gone up by thousands and thousands of dollars per FFE in just a scant few weeks. And going into the U.S. West Coast, we are at about $5,600 per 40-footer. Going into the East Coast, we're almost at $7,000 per FFE. This
Wow.
is approaching some of the peak levels we saw last year, not quite though. So this is where it gets interesting, because the SCFI is to a large degree determined by what are credible rates being quoted. So the thing then is, what is actually then being sold? This is where the NYFI index comes in. And if you look at the NYFI index that have just come out, it's nowhere near. The largest discrepancy you see would be going to the East Coast, where there's now a $3,000 difference per FFE between the NYFI index and the SCFI. And you might start wondering, how on earth can that be? But the explanation is quite logical. And I think the best way to explain these differences, and also why we should expect the NYFI to skyrocket in the coming weeks, no matter what happens, is if we do this graphically. I brought a couple of slides with me. So this is not that I want to kill everybody with a lot of slides, but if we look at the first one here, this is very simple. This is just here in 2025. What's the reading? In this case, I've taken the red line. That's the NYFI. So it's basically, it's not all of the Pacific. This is the one called Far East. So it's essentially China to US West Coast. And that's the red line. And the yellow line is what we saw from the SCFI. You can see at the end here, this gap that I was talking about. But one thing you can also see here is it appears that the NYFI is moving later than the SCFI. And this is not a mistake. This is exactly what's happening for the very practical reason. If you want to measure quotes, that's fine. You can do that right now. But if you want to measure what freight actually gets moved, you have to have a certain lag time. Because by the time I get a quote, then I need to decide I'm going to accept that quote. Then I make a booking. Then I physically need to load my cargo into an empty container. Then that needs to be gated into the terminal. Then it needs to get loaded. So you actually have a fairly long lead time of at least 1 or 2 weeks from the point where you get that quote until you can actually determine, was any cargo moving at that quote or not. So if you want a measurement that actually literally measures what is paid for cargo that is actually moving, it will always come at a little bit of lag time. So the question then is, can we mathematically try to compensate for this? Given that we know for a fact that typically bookings happen 2 weeks before for spot rate cargo, and you can say the NYFI had set a window of 1 to 4 weeks before. If it's longer, then it's not really a spot cargo as such. So if we work with that window, what we can then look at is, what was the SCFI? What then happens if we put this delay factor in? That is the delay between a quote and the cargo actually moved. And that's what I'm going to show in the second graph. If you can pull that one up, Caroline, please. This is exactly what we get. Now it becomes a lot more interesting, right? So what we are seeing here is what people are paying to some degree actually follows the SCFI. But there are a few differences that are massively important. Before we get to those differences, though, note towards the end, the next couple of weeks here in June, because there is, in this case, a lag time between the SCFI and the NYFI, we already have the data to project what would we expect the NYFI index to do the next 2 weeks. We expect the NYFI index here to also escalate at least towards the $4,000 to $4,500 level just over the next few weeks alone, based on the quotes that were made and what we can then historically see what was the relationship. However, there are a couple of quirks here as well. And the best way to look at these quirks is maybe to look at the difference. What is the difference between the NYFI and this adjusted SCFI. So if we go to the third, and I promise you, this is the last slide I'm going to bore you all with, this is what you get. And I call this what it actually is. What is paid versus what was indicated by the SCFI. And here's the interesting thing. For almost the entire period, what gets paid is less than what is indicated by the SCFI. Most of the time here, we are clearly below zero. So this also tells us, yes, there are indications of what gets quoted out there, but it would also appear most of the time here in 2025, though, even on the spot side, the majority of cargo does not necessarily move at the extremes indicated by the spot quotes. They tend to physically move at something that's a little bit less. However, there is one aberration. Note this one in middle April, where suddenly the prices paid skyrocket compares to what we could actually see from the SCFI. This is where it becomes really interesting, because what happened at this very exact moment in time? This was at the exact moment in time where the 90-day pause was announced on all the countries except for China. So here you had the effect that from one day to the next, we went from the massive reciprocal tariffs, so people had been holding back cargo, and then the very next day they were desperate to move cargo. And that desperation clearly led a lot of people to book cargo at rates that were at or even exceeding what you saw in the spot rate indices. This is where it becomes real interesting to see when the market suddenly shifts rapidly and dramatically, what gets paid can suddenly differ from what we usually see from the quotes out there. And if you look at the very last indication here, the last data point we are going above zero again. And I think this is also partly a lagged effect of some of the tariff issues, in this case related with China, is likely going to potentially increase in the coming weeks as well. So if we skip the rest of the graphs here and go back to not boring people with all the graphs, I know this is the largest amount of slides we brought so far. I apologize for that. But I think in this case, a picture speaks 1,000 words. I think it's very, very interesting that we finally begin to be able to analyze the market and the market differences between what is a quote and what kind of freight actually moves, because I think that often gets lost in translation when we talk about the market. Yes, sometimes the spot rates that are being quoted are actually where the market moves. Sometimes the market moves lower, and sometimes it actually moves at higher rates as well. And right now we're moving into yet another very extreme development. So, and of course, the reason I chose this one is the SCFI is probably the one that people know the most. It's been around since 2010, and there's a distinct overlap, at least, between the NYFI on the Pacific to US West Coast and the SCFI. And the Pacific right now is obviously the one that most people are interested in. Before we maybe jump on to talk a little bit more about some of the other market developments, now that we are on the SCFI, I would point the attention to something that people usually don't look at. The SCFI has two other trade lanes that they cover. I was about to say China, but in reality, they measure from Shanghai. One is from Shanghai to East Coast of South America. The other one is Shanghai to the West Coast of South and Central America. And if you think freight rates have been skyrocketing at the Pacific, I was about to say you ain't seen nothing yet, because what's happening from Shanghai to both coasts of South America is far more wild than what you're seeing. You're talking hundreds of percent of increases over just the last 3 weeks. So yes.
Why is that happening?
That's exactly, that's the interesting point. And I think a key here is start to look at demand. And you can say that takes us over to some of the stuff you also mentioned in Caroline that we will talk about, some of the new demand data that came out from container trade statistics. And this is then cargo loaded in April. In April, I believe that the volumes moved, and actually, if you just bear with me a second here, if my eyes are flickering, it's because I'm pulling up a little bit of data here. If I'm looking at it from the perspective of cargo that was loaded in April, the volumes there grew 24%. So that's a 24% year-on-year growth. And that comes after a February of 22%. Looking slightly further back, volumes from the Far East to South America has on average grown between 15 and 20% over the last 7 months. So you have a massive demand boom. And I think this is what is now also beginning to spill into the freight rates of going down there. Why hasn't this happened earlier? I would venture the hypothesis that it might have more to do with there was still capacity to move this. But in the shock we're now seeing up in the Pacific, you still got to ask yourself, all the vessels that are suddenly being amassed and put into the Pacific, where do they come from? and they're going to come from somewhere else. Potentially, this could be some of the vessels that were supposed to carry cargo to South America. So we're seeing absolute skyrocketing rates from Asia to South America. That very much appears demand driven.
It's really interesting seeing that in real time play out from, how the carriers have to finesse moving the vessels around and how it causes fluctuations in rates is pretty interesting. Maybe for our listeners that aren't necessarily moving as much cargo on that trade route, do you know what the typical commodities are that are moving from Asia to South America?
Well, Asia to South America, a good rule of thumb is it's basically the same stuff that moved to North America, that moved to Europe, consumer products. That there's not a massive difference in the type of products that move there.
Okay.
The difference with South America typically is more the export markets that are heavily focused on reefer cargo, on beef, on poultry, on all sorts of fruits and vegetables. That's where South American markets are different from the rest of the world. But on the import side, it is largely driven by the same imports as we also see driving the market into the US and into Europe. But maybe now that we are on the topic of the demand data, what I think is also on people's mind, if demand is skyrocketing down to South America, coming full circle back to the Pacific, what's the demand development into the US? This is where it gets really interesting. Again, keep in mind, this is data for April because CTS data is always lagged, but it's loaded in April. And that means for the very early part of April, it would have been a normal market. Then there is the reciprocal tariffs that first come in on April 7th, then they get on pause by April 9th, except for China. So we need to keep in mind that's the month we're talking about. Volume from Far East into North America is down 10%, actually slightly more than 10%. This is a massive reduction in demand year on year. And the exports are actually down even more. They're down 12%, which is to a large degree then due to the retaliatory tariffs China then placed on US goods. So April, from a demand perspective, very, very poor. The interesting part is Far East to North America down, as I said, slightly more than 10%. Imports from all other regions in the world are growing very strongly, which again has to be with a 90-day pause in the tariffs, where most US importers from everywhere else around the world would have had an incentive to move front load cargo within the 90 days if they could. And that seems to have already manifested itself in the amount of cargo that was physically loaded and moved during the month of April.
Interesting. So we weren't seeing a pattern of this before the tariff announcements in April, right? It was
No, this seems to be a deviation from the pattern that we saw before.
okay. Huh. All right. Well, that'll be interesting to see how that continues over time. I mean, do we think that the China-US demand is going to keep growing? With the announcement here and the tariff ending soon, with the tariff pause ending soon.
That's the really interesting question because if you look at it, the first phase, which we have seen unfold over the last month, that's basically all this cargo that was already produced. I think it was a week or two ago here on the podcast we talked about. I had an estimate of somewhere between 180,000 and 500,000 TEU that was already cargo waiting to go. And that's of course what has created the massive demand push in the Pacific here in recent weeks. Is this coming to an end? It's impossible to get solid data on. I would lean out slightly and say, yeah, we're probably nearing the end of moving that cargo that was already pent up, ready to go. The next step would then be for this surge to continue, it will require the US importers would ramp up their orders in China, trying to get cargo moved before the end of the 90-day, which in this case would then be 12th of August. Again, it's one of these elements. There are no solid hard data out there as to whether or not this is happening. This is where we have to live with all data are somewhat lagged. The closest data point we might have is they got the Purchasing Managers Index over in China, which is basically sort of measuring the Chinese manufacturer's sense of where is the market going. And the latest measurement, which was actually made here during May, went below the index of 50, which means they're expecting a reduction in manufacturing. This could, and I stress hypothetically could, be read as, no, we're not going to get this second wave of surge, because then the manufacturers should be a lot more bullish. But here's the problem. This is a survey that you do with a few hundred companies, and data is gathered basically around the 2 middle weeks of the month. That means that this PMI data was likely gathered about half of it before the announcement of the pause in the tariff and the other half after. So whether this then reflects before or after is actually unknown in that data set. It's hard to put a solid meaning into that number. Yes, the headline indicates that manufacturing in China is expecting a reduction, but I'm not sure we can lend full credibility to those numbers just yet. So we are in the unfortunate position. Everybody would like to know whether this is happening, but with the time it takes to gather data from all the various sources, that the data is simply not there to support it either way as it and you can say
Yeah, it's our favorite game of wait and see.
it's the favorite game of wait and see. And as we also discussed last week, added uncertainties that come in constantly from changes in US regulation doesn't add much more clarity in terms of what should US importers do or not do. What they have been somewhat successful in the recent months, precisely as you say, is wait and see, which is likely what some of them are also doing. There's a limit as to how far you can wait and see with a 90-day pause expiring on August 12th. Early here this morning, news out of the US was that at least the trade representatives that have been sent to London, they are negotiating with the Chinese in London, of all places. They were positive that there would be a trade agreement coming between US and China very, very shortly. I would tend to say, sure, that would be great if there is a trade agreement. It's just this kind of headline we have seen time and time and time again over the last few months. It's kind of, yeah, the proof is in the pudding. They can say that there is a deal coming, but let's wait and see what actually comes out of it.
I mean, maybe it's a good thing that it's taking time. It's more thought out, perhaps, than kind of the on a whim sort of things that it seemed like it's been when they've made announcements about tariffs and reciprocal tariffs and all of
We
that.
could certainly hope so, and we could hope it might be an actual trade agreement, unlike the one that was announced with the UK, which was more an agreement to keep talking to try to get to an agreement of some sort. So let's
Right.
see how that one pans out. But I think an interesting thing to also contemplate then is what then happens, say, on August 12th, if there is not an agreement or if there is an agreement. And in both cases, we should probably expect a downward reaction on demand. Now, obviously, if the market does crash because we have the tariffs coming back on, then fine, we're going to have a massive negative reaction on demand if you get 145% tariff back on. But if the tariffs do not come back on from August 12th and there actually is an agreement, well, to the degree that importers are right now front loading cargo, that also means that a good part of their normal peak season volumes are moving right now. So even if there is a trade agreement, we might still expect a negative pressure on demand once we get into second half of August, simply because of the front loading element. So no matter how we slice and dice it, we should prepare for a market that right now absolutely is very strong and very bullish. But in the absence of new developments, which could be either completely new rules in trades or unexpectedly large congestion or what have you, but with the baseline we're looking at now, these spikes in spot rates, the extremely tight market, the longevity is potentially no longer than mid-August.
Yeah, and as you were saying that, I was also thinking, it might just be another pause. It might not be a indefinite, here's like the new rule, and then you might not have as much of a demand increase from that. But it's a good point that if you're already moving your cargo and you're front loading it, you're not going to have as much to be moving later on this year. All right. Well, any other thoughts before we wrap up today's episode?
No, I think we touched on a lot of ones. I mean, with the risk of repeating myself, what I find interesting is the stuff sometimes that flies under the radar. In this case, the strong markets going into South America and the really rapid increases in spot rates going down there. This is something that really bears monitoring. One thing that I forgot to mention when we were talking demand, I mean, when you're looking back at April, Asia to Europe still coming up very, very strong at more than 8% growth as well. So most trades are extremely strong. It's really only the Pacific right now that was very negatively impacted for the obvious reason.
Yeah, and that one's the one that seems to get all the headlines, at least over in the US, go figure. But
Exactly. And maybe ending up in terms of what gets the headlines, if there's anything to watch right now, the one thing I would watch is, as I'm sure many have seen already now, there are protests, violent demonstrations, call it what you want in, for example, Los Angeles. The reason I'm flagging this one is if I look at it with container shipping ice, you of course have the ports of Los Angeles, Long Beach. Not that I would expect any kind of riots to get to the ports, that's not the point. But depending on the nature of them, this could impact some of the major interstates and freeways leading to and from the ports. So the reason importers and exporters should monitor this situation is precisely for that eventuality, that if this starts to hinder traffic flow on some of the major interstates leading to and from the ports, this could lead to some supply chain issues. Not that there's much that necessarily can be done with it, but I would definitely watch that one if I'm moving cargo to and from.
that's interesting. I would imagine that they're probably doing what they can to prevent that from happening as one of the largest ports in the US. But yeah, there's only a couple of ways to get in and out of the port. So
Yes,
it's
exactly.
good thing to keep an eye on. All right. Well, thank you all for listening. We'll be back next week. Well, I actually won't be. I'll have Don Davis subbing in for me as co-host with Lars. But I hope you all have a great week, and we'll chat soon. Bye, everyone.
Great week, everyone.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.